Let me ask you a question. Have you ever felt that rush of excitement when a coin you own skyrockets? Or the sinking feeling when the market crashes overnight? Let's face it, crypto investing isn't just about numbers. It's an emotional roller coaster. And if you don't manage those emotions, it can cost you more than just money. Today, we're diving into the psychology of crypto investing, how emotions like FOMO, FUD, and overconfidence can derail your plans. And more importantly, how to stay calm and focused in this volatile market. Stick around, because mastering your emotions could be the most profitable skill you learn. Let's start with the biggest emotional triggers in crypto investing: FOMO, FUD, and emotional trading. First, FOMO, the fear of missing out. Picture this: Bitcoin hits a new all-time high. Your feed is full of people sharing their massive gains. It feels like everyone's getting rich except you. That fear of missing the train is so strong, it pushes you to buy at the peak. Then what happens? A correction hits, and suddenly you're in the red. The solution? Have a plan. Set clear entry points for your investments and stick to them. If a coin's already pumped 200%, ask yourself, are you buying the hype or the value? Next, FUD. Fear, uncertainty, and doubt. You've probably seen scary headlines: X country bans Bitcoin, or Y company dumps crypto holdings. Panic sets in, and many investors sell at a loss. But here's the thing, not all headlines reflect reality. For example, when China announced its crypto ban, the market crashed temporarily, but long-term investors who held through it eventually saw gains. The lesson? Don't let fear drive your decisions. Always verify the news and look at the bigger picture. Finally, emotional trading. Let's be honest, when prices swing wildly, emotions take over. You might feel tempted to chase pumps or sell out of panic, but emotional trading is like gambling. You're no longer making rational decisions. To counter this, use tools like stop-loss orders to automate your trades. These tools remove the emotional element and help you stick to your strategy. Now let's talk about the mindset of successful crypto investors. Hodling versus trading. You've heard the term HODL, H-O-D-L, right? It stands for hold on for dear life. It's not just a meme, it's a philosophy. Long-term investors often outperform day traders because they're not swayed by daily price movements. Think about it. If you'd bought Bitcoin 10 years ago and held through every crash, you'd still be up massively today. That's the power of patience. Building conviction is another key. When you understand a project deeply, you're less likely to panic during market dips. Take the time to research a coin's use case, team, and roadmap. If you truly believe in its potential, short-term fluctuations won't shake you. And let's not forget about ignoring the noise. The crypto space is full of hype and distractions. Turn off notifications from influencers and stick to your plan. Remember, the loudest voices don't always have your best interests in mind. Now let's get real about the emotional toll of crypto. Dealing with losses. Seeing your portfolio in red can feel devastating, but remember, losses are part of the game. The key is not letting them define your future decisions. If you've taken a big hit, take a step back. Reassess your strategy and avoid revenge trading, which usually leads to even bigger losses. On the flip side, managing gains is just as important. During a bull run, it's easy to feel invincible. You might think, this will go up forever, but that overconfidence can lead to reckless decisions, like over-leveraging or failing to take profits. Always have an exit plan. Decide in advance when you'll take profits and stick to it. Remember, no one ever went broke taking profits. Let's talk about the influence of community and social media on your mindset. Echo chambers. Crypto communities on Twitter, Reddit, or Telegram can be great for sharing ideas, but they can also create biases. When everyone's bullish, it's easy to ignore red flags. This is how many people got burned during meme coin frenzies. The solution? Be critical. Do your own research and don't rely solely on group opinions. And then, there's influencer psychology. It's tempting to follow the advice of big-name influencers. But remember, they're human too. They might not always have your best interests at heart. And sometimes, they're promoting projects for their own gain. Think of influencers as starting points for research, not as financial advisors. Finally, let's focus on resilience, because surviving in crypto requires a strong emotional foundation. Develop emotional resilience. Volatility is part of the game. The faster you accept that, the calmer you'll be. When the market dips, remind yourself that corrections are normal, not catastrophic. Practice emotional detachment. Don't fall in love with a coin or project. Treat your investments like a business. Analyze, plan, and execute without emotional bias. And always have a plan. Your strategy should include clear goals for both bull and bear markets. When you know what you're aiming for, you're less likely to get swayed by emotions. So, what's the takeaway? Crypto investing isn't just about technical analysis or market trends. It's a mental game. The more you master your emotions, the better your decisions will be. If you found this video helpful, hit that like button and subscribe for more content like this. And I'd love to hear from you. How do you manage your emotions in crypto? Share your thoughts in the comments below. Thanks for watching, and remember, stay rational, stay patient, and happy investing.